Reading price charts, bar by bar. The technical analysis of price action for the serious trader. Chapter 5, Trading Ranges. Table of contents. Tight trading ranges, barbed wire, middle of the day, middle of the range, big up, big down, trading ranges setting up trend reversals. Tight trading ranges. Tight trading ranges happen all the time and they should be avoided. This means the trader waits for a breakout or a reversal. Tight trading ranges show that there is a balance between the bull and the bears. There will be a lot of overlap. Tight trading ranges can be continuation patterns unless they happen after a climax. So here's a tight trading range with lots of overlap. Here we can see the market was in a tight trading range for about 2 days. It was a 12-point range. Here's the overlap, and it was hard to catch the full 12 points. You would have to have limits set already. And if we see right here, the market trends a little bit higher above the EMA, snaps down and reverses right back up. So it's oscillating above and below the EMA. That's balance and overlap. This is a bullish tight trading range continuation. Here are some bullish traits. We have a gap up. These bars show no overlap, show they're trend bars. Then we have a pullback into the EMA that becomes a tight trading range with overlap. See how it's sideways price action versus no overlap? This type of price action should be avoided and we wait for a breakout. Bearish tight trading range continuation. The gap down is a bearish trait, and then we see continuation in the first hour and the market goes sideways into the EMA. This is a 13-point range, so maybe you could take a small scalp, but it'd be better to wait for the breakout or short the range highs. It's buy low, sell high in range environment. It's always better to avoid a tight trading range. And here we can see an example of no overlap versus lots of overlap. It is much easier to trade here and here. Barbed wire. This is a type of tight trading range. This type of price action should be avoided at all costs. Barbed wire can happen in the middle of the day on the EMA. A safe way to trade barbed wire is to wait for a breakout. If you are unsure of which trade to take, it's best to wait. Here's an example of barbed wire. It happened for a very long time. I think this was almost 2 trading days, and it was a 15-point range from the highs to the lows. That's extremely difficult to trade. And here's the same day, but I broke it down into pieces because 15 points was from high to low, so realistically we're not going to be able to catch that every time. The first couple of hours was a 10-point trading range and it was lots of overlap. It had a swing up into another tight trading range which was 5 points. There's your total 15 points, and it took about half a day. That's very tough to catch the lows and sell the highs without expecting a breakout. After the 5-point trading range, the market went sideways for 9 points for another couple of hours. I actually remember getting trapped right here. I went long thinking this was finally breaking out, and it reversed. We can also see balance, how the market trades above the EMA and then under the EMA and then above the EMA. So there's balance and lots of overlap. The market finally ends the tight trading range here with a 7-point range, and it gaps up and breaks out. Middle of the day, middle of the range. Most days the market can range in the middle of the day. If the market starts to go sideways towards the EMA in the middle of the day, the chances of barbed wire are high. If the market is not in a clear trend, traders should be careful trading in the middle of the day. Middle of the day trading range. Here we can see this was a recent day, it's the 6th and the 7th. Market has a gap up, sells off to the EMA, and trends a little bit higher until about 8 a.m. PST, all the way up to around 10:30 a.m. That's 2 hours of sideways price action, and it's easy to get trapped at highs and short into the EMA. If you even wait for a breakout, there's still overlap. So if the market shows signs of a trading range day, be prepared for lots of overlap and quick trades. Big up, big down. After a big move up followed by a big move down, usually to the bottom of the move up, this can cause the market to go range bound. Sometimes this could be the start of a new trend. If this happens, look for reversal patterns. Big up, big down. Here we can see the big move up and then a big move down. The market moved up very fast and then it vacuumed down into support very fast and went into a 15-point range. Again, with this 15-point range, that means you catch the lows and the highs. Realistically, if you buy here or buy here, maybe you catch about 5 to 10 points. This move happened so fast that the tight trading range continued into the next day until the market eventually broke out. Tight trading ranges happen all the time, and even right here we can see after a big move up, the market actually went sideways before it went to another big move down that also went sideways. I'm talking about this sideways price action and then this sideways price action. This is a breakout with no overlap. This is sideways price action with lots of overlap. No overlap, overlap. It's really important we start to identify the difference between a breakout and a trading range. Trading ranges setting up trend reversals. When the market makes a move in one direction and starts to reverse, this could be a setup for a trend. For the bulls, the market could race to support and reverse into a trend. For the bears, the market could race into resistance and then reverse into a trend. Bullish reversal. Here we see the tight trading range in the morning and the market sells off into support. These 4 bars are a tight trading range on a smaller time frame. After that, we see trend-like behavior and the bulls start to create gaps. They get their breakout above the high of the day and this gap stays open. The EMA starts to act as support and the market sees new highs at the end of the day. This is all trend-like behavior that started within a tight trading range. Bearish reversal. Here we can see the market races to resistance and starts to reverse. This is a tight trading range at the high and has lots of overlap. Here's no overlap, here's lots of overlap. The market reverses and breaks below the EMA and trends lower for a few hours. These bear gaps show us that the trend is starting right here. The gaps stay open, and when we pull back into the EMA, the market sells off again. This trend started out as a bull trend. This bear trend was bullish in the morning, it raced to resistance and sold off. This is the end of chapter 5. Please leave any questions in the comments and I will try my best to answer them. Thank you for your time, and if you learned anything, please consider subscribing.